I promise you, if you watch this video, it will help you demystify the process of investing in real estate private equity. What's up, guys? My name is Justin Ryder. I'm a commercial real estate broker and content creator based out of Lexington, Kentucky. In today's video, I'll be discussing the who, what, and when of investing in real estate private equity. Our tool today is a book sourced from Real Estate Twitter, Retweet, or now X. And this book honestly has become sort of a rite of passage when it comes to real estate people on Twitter. You see beginners reading it, you see experts reading it and recommending it on their blogs and websites. So what is so special about this book? I read it, one, to find out, and two, because I want to invest in good deals myself. And in fact, it led to 3 separate investments as an LP in deals that are very solid. The principles of this book actually led me in the direction of those deals, and it will do the same for you. Now, in a world of real estate content that screams, get rich quick, depend on cheap debt, and do it yourself, this book takes a sober and educated approach. Play the long game with trustworthy operators, mitigate risk, and of course, withstand cycles. Let's dive into the who, what, and when of investing in real estate private equity. Let's go. All right, number 1, who. The who, first of all, is not you. There's a massive miscalculation amongst those interested in investing in real estate that you have to go solo. A lot of people think to get started in real estate, I have to start small, buy something myself, run it myself to keep costs down, and that's how I'm gonna do well. The who is most likely a successful general partner or GP or sponsor of deals that you can actually invest in. Now, one of the major takeaways from this book that I will never forget is that the sponsor is often more important than the property itself. A great operator can take a mediocre property and turn it into gold. A terrible operator can take a golden property and make it mediocre or even create losses. Who is the sponsor? Who is actually running the deal? That's paramount when you talk about investing in real estate private equity. Now, the author has some very simple rules for vetting that sponsor or GP so that you're comfortable actually investing your hard-earned funds with them. Number 1 is simply to ask really good questions. So what is their reputation? Who is on their executive team? How many successful exits have they actually had? Does their website communicate as such? The author's second rule is one I love, and it's very simple. Do not invest with jerks. Why is that? Because when things go bad, guess what jerks will do? They will be jerks. So I like that he lays that out. Now, this individual, this GP or sponsor, will control the investment vehicle. And I love in this book that you get examples of the individual mechanisms for buying property in ways that limit the liability for yourself, i.e. a limited partner or just member of the LLC. Now, this book allows you to compare various structures, their advantages, their disadvantages, and what you have to be to actually get into a deal, i.e. if you have to be an accredited investor. Let's talk about that. Now, the best example of this might be a simple limited partnership. Now, that limited partnership would be controlled by a GP. That GP would make the day-to-day decisions on the property, including management and potentially collecting the profit, which would then flow to the limited partners. Now, what's nice about this structure is that LPs are typically shielded from liability in case something goes wrong. But guess what? You have to check the operating agreement and consult with your local attorney on exactly what you're signing up for to see what liability you're shielded from. Now, one misconception I see all the time about GPs and sponsors or real estate investment companies is that if they don't have a 30-year track record, I can't mess with them. And folks, I can't tell you how untrue that is. Just because someone hasn't been around for 30 years doesn't mean they can't do a great job for you. In fact, it might be worth investing in someone's very first deal. You just have to understand what you're looking at and what their plan is. Now, something I didn't understand when I first began my career in real estate was how these GPs or sponsors get paid. And of course, their incentive or their motivation to do well lies in the financial gain on the other side. Certainly making money for investors, but also building an incredible company. To do that, you have to make profits. So how do GPs and sponsors get paid? Consider profit that starts to flow from a property into a first bucket that we'll call an 8% bucket. This represents an 8% preferred return to all LPs. No money can go anywhere else until the LPs have made their 8% preferred return. If there are further funds, they're distributed into the second bucket. We'll call this bucket an 80-20 bucket. That's because 80% of the profit is distributed to LPs, while 20% is distributed to the GP. Still, the waterfall continues to go down to the third bucket because there's plenty of profit, and we'll call this 60-40 with a 60-40 split from LP to GP. Now, this helps answer the age-old question about cash flow. How much cash and when does it flow? So that's the who of investing in real estate private equity. You've found a sponsor or GP that is worth their fees. In fact, you're excited to pay them. Now let's move on to the what of investing in real estate private equity. And the what, as you might guess it, is a solid deal. Because the what is a solid deal, you have to look at what type of property it is and where it is. So whether the property is retail, industrial, multifamily, single tenant, triple net, land, there are ways of evaluating each specific product type and location. The GP's job is then to conduct due diligence on the property, answering that question and many, many, many others in an effort to build a plan to add value to the property. Folks, that is the name of the game and the secret sauce to real estate investing. In an actual value add situation, you're going to improve the properties physically or operationally. That physical or operational improvement are going to attract more and better tenants who will pay higher rent, thus improving the cash flow and making the property more valuable. Adding value to properties is actually very difficult. In fact, there's a broker from LA who's an amazing follow named Jake Glossier. And the other day he tweeted that he had received an email about a turnkey value add property. I love that. I thought that was really funny. There is no such thing as a turnkey value add property. The next question you need to be asking yourself about the what is actually, what is the return being promised to me? Financial projections will be provided to you, but the key to understanding financial projections is that they are, in a sense, all economic storytelling. While most deals can be analyzed on the back of a napkin, almost 100% of the ones that you receive will have thick packets of information, spreadsheets showing the modeling of how the GP is promising a certain return and what's going to happen with the property. Make no mistake, neither of these approaches are bad, the simple or the complex. What's essential for you is to understand the variables that are involved in creating the models, because one change of a variable can completely alter the projections on a property. Now, even with something as simple as the exit cap, it can completely change the projections on a property. For example, let's say you invest $1 million into a property and that property is going to produce $60K a year for the next 5 years. Now, we understand from simple math that you bought this property at a 6% cap rate. Now, if we believe that cap rate is going to compress to, let's say, a 5.5 cap, we're assuming you can sell the property for around $1.1 million for a profit. So $1 million in, 60 a year, and then 1.1 on the back end. If you run that math, that's an IRR of 7.71%. That's neither good nor bad. That just is what it is. That basically means that every dollar in the investment, as long as it was in the investment, earned you 7.71%. Now let's change the exit cap rate. Instead of a 6% cap rate, let's assume that you actually sold it at a 7 cap, or essentially around $860,000. Unfortunately, then your IRR drops to a 3.38% internal rate of return. That one variable changed the entire investment. You could change rent growth over the expected hold period. Is the rent going to grow? Will it increase? Could it decrease? Something like insurance could blow up your expense budget, which is happening a lot right now as insurance rates have gone up. So expenses on the property go up. If rent doesn't go up, you're gonna keep less of your money. The point is that the economic modeling is a guess, but it should be a really good guess. And the stronger the track record on the GP or sponsor about guessing, the more weight you can give to what they actually believe is going to happen with the property. And of course, this book has one of the best quotes about economic modeling that I've ever heard, which is the following: "We systematically and significantly underestimate the volatility of market conditions." Next is how you're actually gonna purchase this property. And that gets into what GPs or sponsors will call the cap stack or capital stack. Now, this is the layered structure of all the types of financing that's used to purchase and then maintain the property. The most simple example is buying a property in all cash. If you were to do that, your equity would look like the following. Of course, people don't have all cash to buy property, and properties are very expensive. So to take advantage of the increased leverage, you're probably going to use not just cash, some cash, but the rest is going to be debt. Now, of course, you're also going to find in this book that there are many different ways to do cap stacks. For example, you could have some equity, you could have some debt, and alternatively, you can have some mezz debt, which is subordinate to the first place debt on the deal. From the standpoint of debt, the author goes into lenders and exactly what they're looking for on deals, how they get paid, and why they lend certain deals over others. There's also a hint in here about being conservative and or risky, because as time goes on, the risk will actually go up the more debt you have. The debt will make demands on the income the property is producing, especially if it changes. So we've gone through the who, we've gone through the what. Finally, we're going to talk about the when of investing in real estate private equity. What I took away from this book are 2 when statements that I believe will help you determine the timing for your next investment. One is a quote that I'll never forget that the author said: "When conference attendance is at all-time highs, I recommend being judicious about the types of investments you make." Why is that? When there's a feeding frenzy, typically prices are getting bid up. Now, we've seen this over the last couple years, namely late 2020, 21, and early 22. Of course, that doesn't mean that all deals done during those times were bad deals. But the point is that you want to buy when there's blood in the streets. And that's typically when there's some distress. People are afraid to buy or they can't buy. That's when you want to have cash and really get in the game. For me, the reason I really love this book, and we'll come back to it time and time again, and maybe the reason you'll like and subscribe to this channel and come back to this video, is because of a simple message the author includes, and that is don't blow up. The encouragement is to use modest debt to stay in the game long term. I think of this as the don't blow up graph, which I've now drawn for 20-something clients and often come back to. Staying power in real estate, or don't blow up. The picture, of course, is you're always measuring debt against potential returns. Using modest debt may produce less returns, but in a downturn will keep you in the game. So we'll call this modest debt. Now, higher leverage, where you take more risk, will be worse off in a bad cycle or downturn. In fact, it may be so bad that it causes a default or foreclosure type situation. Of course, if you're able to hold on to a property long enough, typically the next cycle will bail you out. The market will come back. If you lose your staying power, if it blows up, you can't stay in the game. If you lose the property, it's the next operator that takes the property to the next level and actually benefits from your default or foreclosure. Now, the caveat to all this is that the who, what, and when of real estate investing is still going to be local. In fact, I would call it ultra local, unique to your community or the community that you specifically want to invest in. For me, there's nothing better than sitting down with a client and talking about the potential of real estate investment, what it can do for their family and their business long term. I hope you enjoyed this video and that it spurs you to read something like this and demystify the process for yourself. It's more than possible for you to get out in your local community, find the who's, find the deals, and look at 24 and 25 as an incredible opportunity to invest. Thanks for joining, and we'll catch you in the next video.